Think your IRA is yours? Think again. It's actually a joint account with Uncle Sam. Most people focus on saving for retirement, but few know how to take that money out the right way. And that's a problem because unlike market losses, money lost to taxes never comes back. Your IRA is an IOU to the IRS. It's a growing, compounding tax bill. But the good news, you can take control. The question is, do you want your plan or the government plan? Now, it's important that you know, at Slott and Company, we are an education company. That's it. That's all we do. We do not sell stocks, bonds, funds, insurance, annuities, or any investment products. That's why we can provide independent, objective, and unbiased advice you can rely on. Hi, I'm CPA and retirement tax expert Ed Slott, and I'm here with my team of the nation's leading IRA tax experts. We'll show you how to keep more of your hard-earned retirement savings by addressing the single greatest threat to your retirement savings. Nope, it's not your kids, it's the taxes. Your IRA is loaded with taxes. It's a growing, compounding tax bill, and one wrong move could cost you thousands in excessive and unnecessary taxes. Your IRA is like an eggshell. Break it the wrong way, and there's just no going back. We'll show you exactly how to take control of your retirement savings legally, ethically, and strategically so you can keep more of what's yours. Before we dive into the specifics, there are a few key things to keep in mind when it comes to retirement tax planning. What works for one person may not work for another. One size doesn't fit all. Mistakes are often irreversible. IRA rollovers, Roth conversions, and RMDs all have serious consequences, serious tax consequences if done wrong. Sometimes you need expert guidance. Later in this program, we'll show you how to find trained advisors with the expertise to help you. To help you avoid the biggest tax traps, we created a free guide, The 9 Retirement Tax Mistakes That Could Cost You Thousands and How to Avoid Them. Download it now, and you'll also receive our quarterly newsletter featuring the Retirement Tax Roadmap by age to help you understand key financial decisions in your 50s, 60s, and 70s. With me today are America's IRA experts who answer over 5,000 of the toughest retirement tax questions every year from financial professionals, the media, and retirement savers just like you. Let's welcome our IRA tax experts, tax attorneys Sarah Brenna and Ian Berger, and certified financial planner Andy Ives with over 70 years of combined expertise, 100 years if you count mine. Now, let's start with those of you in your 50s and the biggest tax planning opportunities and risks you need to know.
When we talk about what you need to know about retirement savings in your 50s, I know I'm talking to my fellow Gen Xers. It's hard to believe we are almost at retirement age. Maybe you started saving late, or you're now just recognizing that you don't have enough saved. One tool that is available is catch-up contributions. If you're age 50 or over, by the end of the year, you can go ahead and contribute a little bit more. This is called a catch-up contribution, and it's available for both plans and IRAs. This is a good opportunity to get more dollars into retirement accounts. We have a chart available with the most recent amounts allowed as catch-up contributions to both plans and IRAs. Of course, while some people are contributing to retirement accounts in their 50s, others may need to tap those accounts, right, Ian?
That's right, Sarah. Sarah just spoke about how you can put extra money into your IRA or retirement plan. I'm now going to discuss pulling money out of your IRA or plan. If you withdraw from your IRAs or plans during most of your 50s, that is before 59 and a half, you may be subject to a 10% early distribution penalties. IRAs and plans are designed for retirement. They're not supposed to be checking accounts. The 10% penalty was imposed to make you think twice about rating your retirement savings. But real life gets in the way, and Congress has created a number of exceptions to the 10% penalty, and that list just keeps getting longer and longer. There are now 20 exceptions. We have a chart available for download that lists all of these exceptions. Some exceptions apply to both IRAs and plans, like medical expenses. Some apply to just IRAs, like first-time homebuyer expenses. And some apply to just plans, like distributions after leaving your job on or after age 55. You will have no success claiming an exception from the wrong category. Here's an example. The exception for higher education expenses only applies to withdrawals from IRAs. In several court cases, the person claimed the exception for withdrawal from a plan, not from an IRA. And in every case, they lost in court. It's important to remember that just because you qualify for a penalty exception doesn't necessarily mean that you should take a withdrawal. The withdrawal amount will likely still be taxable, and the withdrawal will reduce the amount available for retirement.
That's right, Ian. There are currently 20 exceptions to the 10% early withdrawal penalty, and that is good news. But it's important to understand the details of each exception before trying to leverage one. For example, the disability exception. It's super strict, a high hurdle to get over. Simply being retired on disability may not qualify. We see example after example of failed disability claims with a 10% penalty exception. The first-time homebuyer exception is another one that confuses people. It has its limitations, only a $10,000 lifetime maximum. I'm not sure how much of a dent that will make in buying a home, but it could help with a down payment. However, there are some exceptions to that penalty, like you cannot have owned a home for the previous 2 years. That also applies to the spouse of the person buying the home. The higher education exception is another one. It applies to IRAs only. There have been many court cases where people took distributions from the wrong type of account, claimed a 10% penalty exception, but were denied because of the type of account where they took the distribution. Remember what Ian said. Some exceptions apply to just plans, some to just IRAs, and some to both. That covers the 50s. Ed, I know you have a good nickname for people in their 60s.
I have a great name. I call it the sweet spot. It's the decade where you have the most control over the tax rates before RMDs start forcing money out at higher tax brackets. Sarah, how can people take advantage of this window to reduce lifetime taxes and keep more of their savings?
Yeah. The last chance to control taxes before Medicare surcharges and RMDs kick in would be with conversions prior to age 63. One smart strategy to consider early in your 60s is Roth IRA conversions. When you do a Roth IRA conversion, you move your pre-tax traditional IRA funds to an after-tax Roth IRA. You will have a tax bill in the year of the conversion, but after that, you'll be able to enjoy tax-free Roth IRA earnings and distributions in retirement. You will not need to worry about taking any required distributions in retirement, and that's a good thing because taxable RMDs increase your income and can result in both the taxation of Social Security benefits and higher Medicare premiums. A great time to do a Roth IRA conversion is before you reach the year you turn age 63. Why? Well, you may have heard of IRMA. What is IRMA? It is the Medicare Income-Related Monthly Adjustment Amount, IRMA, quote unquote. These are increased charges added to Medicare Part B and Part D premiums for those with higher incomes. These are based on your tax returns from 2 years prior. So Roth conversions done at age 63 or older can increase IRMA charges 2 years in the future. These are cliff brackets. $1 over a threshold level will result in a year of elevated Medicare surcharges. Do Roth conversions at ages 60, 61, and 62 and avoid this hit.
As you age into your 60s, you have a great opportunity to supersize your retirement plan deferrals. Starting in 2025, you can make higher catch-up contributions to your 401k, 403B, or governmental 457B plans. What is a catch-up contribution? It's a contribution over and above the regular contribution limit. The extra catch-ups that became available in 2025 are for employees aged 60 to 63. These are called super catch-ups. Keep in mind that super catch-ups are optional, not mandatory for plans to offer. So check to see if your plan permits them. The super catch-up is 1.5 times the age 50 catch-up for people who turn age 50 or older during the year. But super catch-up contributions are not in addition to the age 50 catch-up. They are instead of the age 50 catch-up. To qualify, you must turn age 60, 61, 62, or 63 during the year. No one knows why Congress chose those ages. If you turn 60 anytime during the year, even on December 31st, you qualify for the full super catch-up for that year. But if you turn age 64 anytime during the year, even on December 31st, you don't qualify at all. If you are in a simple IRA, one of 3 different catch-up limits could apply to you. First, your employer probably offers the age 50 catch-up. Second, if your company has 25 or fewer employees, starting in 2024, you could contribute 10% more than the usual age 50 catch-up contribution limit. And third, starting in 2025, even higher super catch-ups are also available if you're ages 60 to 63. So if you're 50 or older, definitely check with the Simple IRA plan to see what your particular catch-up limit is.
Those are great special benefits, Ian, for people in your 60s. Think about Roth conversions. Remember, it's the sweet spot in your 60s. In your 60s, that's the last window before RMDs start, actually at age 73, forcing withdrawals from your IRA. And here's another idea. If you don't need the funds for living expenses, you might want to consider shifting some of that balance into tax-free vehicles like cash value life insurance. This can do 2 things. It lowers your future RMD burden by reducing your IRA balance, and it can create a tax-free death benefit for your heirs rather than leaving them with a big taxable IRA inheritance. But you have to be careful of mistakes, right, Andy?
For sure. One of the first things you mentioned was Roth conversions. Failing to implement strategic multi-year Roth conversions and missing the opportunity to lower lifetime taxes could be a big miss. Roth conversions are a popular strategy, but there are different techniques to implementing Roth conversions. One strategy I like to call dollar cost averaging into a Roth. Now, I'm sure you're familiar with dollar cost averaging into a mutual fund. That's where you buy a little bit of that fund, let's say every month or every couple of weeks, to help smooth out market volatility. You can do the same thing with a Roth conversion. Instead of doing one big Roth conversion at the beginning of the year, maybe do 4 conversions throughout the year. Again, this can help smooth out market volatility. If you do a conversion in the first quarter, and let's say the market tanks, there's no reason why you couldn't dial up a little bit of a higher conversion for the next quarter. Another strategy is the bracket bumping strategy. We're all in a particular tax bracket. Some people are maybe bumping their heads on the next bracket. To avoid drifting into that next bracket, you can convert just enough to bring you up to that next level. So if you're confused about maybe how much should you convert, the bracket bumping strategy can help you identify a particular number. Now, sometimes it pays to pay taxes up front, and we can see that with the Roth conversions, but you've got to take the long view. Ed, remember that angry person that was at one of your seminars?
Yeah, it's exactly like you said. You have to look long term. Don't focus on what does it cost now. So there may be some taxes up front. So the story that Andy was referring to, an actual story from one of my consumer programs, I was talking all about Roth conversions, and she was talking about those IRMA charges we just covered before, the Medicare charges, and that was causing her some problems. And she stood up in front of the whole audience and said, Ed, I like everything you said about the Roth conversion, but I'm on Medicare. If I got you right, if I do a Roth conversion, that's going to increase my income, correct? I said, yes, it's in front of the whole group. And she says, well, if that increases my income, that could increase my Medicare surcharges every month. Is that right? I said, yes, that could happen. And she said, well, if that happened, That would make me very angry. So I said to her, you know what? If that would make you angry, then convert anyway. I'd rather have you be angry for 1 year than be angry for the rest of your life. Because if you do nothing, again, taking the short-sighted view, that IRA continues to grow. And if you do nothing, when you're forced to take RMDs at age 73, those RMDs can cause the very problem that got you angry for the rest of your life. Sometimes you have to take the long view, and that's where good tax planning takes effect. You look at lifetime. Andy mentioned lifetime tax bill. Well, we're just scratching the surface here on Roth conversions. This strategy could save you tens of thousands in taxes. If you want a step-by-step breakdown, check out the link below for our deep dive video. Okay, now let's talk about what happens when you hit your 70s. I'm not talking about the decade of the 70s. We know what happened then. It was called disco. All right, we're talking about you being in your 70s now. We're talking about required minimum distributions. Sarah, what do people need to know about that? Not disco, the RMDs.
Ed, let the disco dancing begin. Unfortunately, what goes in must come out. It's the deal you make with the devil when you contribute to a traditional IRA. When you reach retirement age, you will need to take required minimum distributions. For IRAs, these annual payments must start beginning with the year you reach age 73. Your first distribution must be taken by April 1st of the year following the year you reach age 73. We call that the required beginning date.
You also call it April Fool's Day.
That's right, Ed. To calculate your RMD, you divide your December 31st prior year balance by a life expectancy factor that matches your age. Where can you find that life expectancy factor? Well, you can find it on the IRS Uniform Lifetime Table. And we have these tables available for download for you. There's good news. If you have a Roth IRA, you don't need to take RMDs during your lifetime from your Roth IRA. What if you miss an RMD? If you miss an RMD, there are penalties. It's a 25% penalty. Ouch.
A 25% missed RMD penalty is painful.
For
Sarah,
sure.
you're right. And so are taxes. Yes, you do have to start taking RMDs at age 73, but there is a way you can reduce the pain of applicable taxes. How so? QCDs, Qualified Charitable Distributions. QCDs can reduce RMD taxes and maximize tax efficiency. But first, what is a QCD? With a Qualified Charitable Distribution, IRA money is sent directly from the IRA account to an eligible charity. By going directly to a charity and not being paid out to the IRA owner, the amount of the QCD is excluded from income. But there are strict guidelines to make sure your QCD is done properly. First, you have to be age 70 and a half or older. That's a bit of an anomaly. We know that the RMD age is 73, but the QCD age is still 70 and a half. A QCD can offset an RMD, but can do more than the RMD. QCDs have an annual limit of a little more than $100,000. So if your RMD is only 10 grand, you're not limited to the 10 grand. You can go up to a little over 100,000. While using a QCD is a proactive way to deal with RMDs, I believe Ian has an example of how not to handle an RMD.
I do indeed. We've talked a lot about RMDs, required minimum distributions. Here's a common RMD question if you retire in your early 70s. If you retire at age 73 or older, and you want to roll over your 401k to an IRA, do you first have to take your required minimum distributions? Well, it would seem the answer to that question should be no. After all, RMDs don't have to start until the April 1st after the year you turn age 73. Or it's April 1st after the year you retire if you're still working and you don't own more than 5% of your company. So if you retire before that April 1st, it wouldn't seem that you would need to take the RMD before doing a rollover. That explains why many people fail to take the RMD first. But here's why that RMD is required. The ability to defer to the next April 1st is actually trumped by 3 tax rules. First, a direct rollover from a plan is considered a distribution and then a rollover. Second, the first funds distributed in a year where you need to take an RMD are considered the RMD. And third, RMDs cannot be rolled over. Well, putting all three of these rules together, here's the rule. The first dollars distributed as part of a direct rollover are considered the RMD and cannot be rolled over. If you don't take out the RMD, you have an excess contribution. You must fix that by a particular deadline to avoid a penalty.
Oh yeah, and RMD penalties can cost you thousands. If you want to avoid penalties or consider QCD, remember Qualified Charitable Distribution Gifting Strategies, check below for a link to this deep dive video. Well, we've been talking about the 50s, 60s, and 70s. Sounds like I'm a radio DJ, like the hits of the 50s, 60s, and 70s. No, I'm talking about the ages, the decades of the 50s, 60s, and 70s, your age. But some of the biggest mistakes can happen at any age, like rollovers, getting laid off, retiring, changing jobs. Ian, what's the number one mistake? I'm teeing it off. The number one big hit, the number one big tax hit you can hit at any age.
Okay,
Top of the charts, Ian.
I guess I have to answer that question. The number one mistake is doing a 60-day rollover. Now, what do we mean by a 60-day rollover? A 60-day rollover occurs when you receive funds from an IRA or retirement plan and you move those funds to another IRA or retirement plan or back to the original one. That 60-day period starts when you receive the funds. But 60-day rollovers can create lots of problems. If you receive a payment from a retirement plan that you don't directly roll over, the plan must withhold 20% for federal income tax, and that means you're only going to get 80% of your account balance. And you can't waive out of that withholding. Furthermore, if you miss the 60-day deadline for an IRA or a plan rollover, you have a taxable distribution. And on top of that, possibly a 10% early distribution penalty. And that may be very expensive to correct. To make matters even worse, if the rollover somehow goes through, you have what's called an excess contribution, and that must be fixed by a particular deadline to avoid a penalty. Another problem with 60-day rollovers is what we call the once-per-year rule. The once-per-year rule says that you can't do more than one 60-day rollover between traditional IRAs or between Roth IRAs in a 12-month period. If you violate this rule, once again, the distribution is taxable, and you also may have a 10% penalty. If you do more than one IRA rollover within 12 months, that's a mistake that cannot be fixed. Every one of these problems can be avoided by not doing a 60-day rollover. Instead, have the IRA custodian or plan administrator move the fund directly to the new IRA or plan. This is known as a direct transfer or direct rollover. Sometimes the custodian or plan won't cooperate and they won't move the funds directly. They will instead insist on issuing a check. But in that case, there's a good workaround. Have the check made payable to the receiving IRA or plan, not payable to you. That counts as a direct transfer or direct rollover.
Wow, Ian, that is important information to keep in mind. When people change jobs or retire, they have a big decision to make with regard to their retirement savings. It can be a really stressful time, but it's important to take a minute and pause and consider all the possible options. Don't act too quickly. I like to compare it to going to a buffet for dinner. You want to be strategic, right? You want to consider all of your options and choices. You do not want to make the mistake of filling up on bread and missing out on the filet mignon because you are too full. What are your options when you are going to be receiving money from an employer plan? Well, one thing you can do is you can keep the money in the plan. That choice would offer creditor protection. Why? Employer plans get protection under ERISA, and ERISA is the gold standard when it comes to protection from creditors. Or You can take a lump sum distribution from the plan.
Why would anybody do that?
I know that sounds surprising, doesn't it? But if you have highly appreciated stock in your employer plan, this can actually be a good move. You can take advantage of long-term capital gains rates when you sell the stock outside the plan. This is called the NUA tax break, and I'm sure you guys will agree, it is often overlooked. Well, you're going to lose the ability to do NUA if you roll over too quickly.
I just want to jump in. NUA, net unrealized appreciation. Now, this is serious stuff and it's complicated. This may be an area where you want to get educated on this program, but you may want to seek out the help of a professionally trained advisor that has knowledge in this area, because you really only get one chance to get this right.
That's right, Ed. If you happen to be in this situation where you have company stock in your employer plan, you want to take a minute and you want to decide, do I want to go with NUA? Do I want to take advantage of long-term capital gains rates on that employer stock? If you don't think through your options, if you act too quickly and you roll over to an IRA, you will lose the NUA tax break. With NUA, I know you talk about NUA a lot, Andy. With NUA, it's really important that you follow every little rule. One mistake can be a fatal error. So it's really important, if you're in this situation where you have highly appreciated stock in your employer plan, you absolutely want to talk to an educated advisor. Have them lead you through the process.
Yeah, there's too much at stake.
Absolutely. Let's talk IRA rollovers. That is one of the options that you have when you're getting a distribution from an employer plan. And it's a popular choice, and for good reason. For many people, it is a smart way to go. Why? Well, IRAs offer investment choices, almost an unlimited universe of investment choices. IRAs offer RMD simplicity. If you have multiple IRAs, you can aggregate your required minimum distributions and take the total amount from one IRA. Nice and easy. IRAs also offer the opportunity to do qualified charitable distributions. You can't do a QCD with a plan. There are a lot of options. You could keep the money in the plan. You could do NUA. You could do an IRA rollover. It's important to move your money in the right way.
For sure, Sarah. And I can tell you about a story about a person that didn't do things the right way. So there are countless cases of people mishandling rollovers and triggering an unexpected tax bill. One that comes to mind is the Mulhern case. Carol Mulhern attempted to complete a plan to IRA rollover. However, she triggered an unexpected tax bill by handling the rollover incorrectly. Where did she go wrong? Mulhern requested that the plan distribute all dollars directly to her. Remember what Ian just talked about. This prompted a mandatory 20% withholding by the plan. As Ian said, plans are required to send 20% to the IRS when plan dollars that are eligible to be rolled over are sent directly to a plan participant. So what did Mulhern do? She fought the plan, requested a cancellation of the checks, argued, and eventually went to court. She lost. What could she have done? Well, if she had been working with a knowledgeable advisor, that advisor could have advised her to, if she had extra cash on hand, simply replaced the 20% missing money to complete a 100% rollover. And then she could have potentially recouped the 20% withheld dollars when she did her taxes the following year. Understanding the impacts of your rollover decisions prior to submitting any paperwork is imperative, as I'm sure, Ed, you would agree.
I absolutely do agree. If you're moving money from one account to another, even one wrong move can trigger steep taxes and sometimes irrevocable fatal errors, as we talked about. We break this down in our Rollover Mistakes Deep Dive in the link below. Now, switching gears a bit for something completely different, also things you can do at any age, not just your 50s, 60s, or 70, any age. To get this all right, many people don't realize that their will or trust doesn't control who ultimately receives their IRA or 401k. Andy, what's the biggest mistake people make when it comes to passing on their retirement savings to their beneficiaries?
Ed, the biggest mistake is not recognizing that IRAs pass through beneficiary forms, not the will. Beneficiary forms override everything, and outdated paperwork can derail your estate plan. We see case after court case where beneficiary form problems turn people's lives upside down. For example, situations where there was no beneficiary form, situations where there were no contingent beneficiaries listed, situations where beneficiary forms were never updated. That simple step, updating the beneficiary form, can save your heirs a lot of heartache and ensure they receive the best possible payout options. Our advice: review beneficiary forms annually, especially after any life-changing event like a divorce or death of a spouse. We've seen children get disinherited due to beneficiary form mistakes. We've seen beneficiaries act with good intentions but get nailed with a tax bill because they didn't understand the consequences of their actions. All kinds of beneficiary form errors can happen at any time. Bottom line, beneficiary forms are super important, as is understanding what options each type of beneficiary has after they inherit. Now, not all beneficiaries are the same. Ian has some comments about some of the special options a spouse beneficiary has.
Yes, I do. The most common IRA beneficiary is the surviving spouse. Married people get all sorts of special breaks under the tax rules, as I always remind my wife. It's no different for spousal IRA beneficiaries. Only spouses have the option of rolling over the inherited IRA to their own IRA, and we call that a spousal rollover. This is a big advantage for younger surviving spouses. They can defer RMDs, which are required minimum distributions. But a spousal rollover is usually not the right move if the spouse is younger than age 59 and a half. The reason for that is that if the surviving spouse must tap into the rolled over funds, she will be subject to the 10% early distribution penalty. So surviving spouses should usually maintain their inherited IRAs until 59 and a half, rather than doing a spousal rollover. When they maintain an inherited IRA, a surviving spouse has two advantages versus a non-spouse beneficiary. First, she can delay RMDs, required minimum distributions, until the deceased spouse would have reached age 73. That can be a big advantage. And second, when the surviving spouse must start taking RMDs, she can usually use a more favorable IRS table to calculate those RMDs. And that table will produce smaller RMDs compared to the table that non-spouse beneficiaries must use. Spouses also have special beneficiary rights in plans covered by ERISA, E-R-I-S-A. ERISA is the federal law that regulates many 401ks and other plans. In an ERISA plan, a surviving spouse is automatically the beneficiary unless two things occur. First, the plan participant must designate a non-spouse beneficiary. And second, and more importantly, the spouse must give consent to that designation. Now, the rules are different for IRA owners. IRAs are not covered by ERISA, so most married IRA owners can name any beneficiary they want without getting spousal consent. Now, there is an exception if you live in a community property state like California or Texas. There, spousal consent is required for IRAs opened up during the marriage.
I have a story to tell you about the importance of the beneficiary form. I had an attorney call me not long ago. He did a will for a client who had recently passed away. Let's call him Len. We'll protect the not so innocent here. Len worked at a grocery store his whole life. His will left everything to his beloved nephews. His will deliberately did not leave anything to his no good brother. Len was super clear. He wanted everything to go to the nephews and nothing, absolutely nothing to go to the no good brother.
I know where this is heading.
Yeah, I would stop the same thing.
Well, Len thought that the will would take care of everything. And as we all know, right, he was wrong. Len had a big 401k at the grocery store where he worked. And guess what? He never named a beneficiary on the 401k plan. As a result, the default beneficiary under the terms of the plan was the nearest family member. And guess who that was?
The no good Nick.
You got it, the no good brother. The no good brother got all the money in the plan, and the nephews were so upset. They thought that the will would take care of everything, but we all know that's not the way it works. The retirement plan assets are inherited through the beneficiary form. And it was the no good brother who got everything. Why? Because he was the default beneficiary on the beneficiary form.
Most people assume their will or trust covers everything,
Yep.
but that's a costly mistake.
Absolutely.
If you want to ensure your heirs inherit as much as possible, or if you have recently inherited a retirement account, check out our detailed beneficiary planning deep dive available at the link below. Well, your IRA may have started, remember that, as a joint account with Uncle Sam, but today you've learned how to take control. We've covered the biggest retirement tax mistakes and, more importantly, how to avoid them. From your 50s to your 70s, you now understand how to lower your taxes, avoid IRS penalties, and protect more of what you've saved. The key is knowing the right moves at the right time. If you haven't grabbed it yet, get your free guide, The 9 Biggest Retirement Tax Mistakes That Could Cost You Thousands. Plus, as a bonus, I love bonuses, you receive an exclusively quarterly update with expert insights and tax strategies to keep you up to date on the latest changes. Go to the link below and download it now. Even with everything we've learned today, there's always more to learn. Want to go deeper? We have detailed sessions on Roth conversions, RMDs, rollovers, and beneficiary planning. Check below for links to these deep dives so you can put these strategies into action. Retirement tax planning is not something you want to guess on. One mistake can cost you thousands. You're learning a lot here, but sometimes you have to go further and be your own advocate. That's why we recommend working with a trained professional who specializes in these strategies. Slott's Elite IRA Advisor Group is a network of financial professionals with advanced training in retirement tax planning. Now, they're not the only ones, but members of our group train with and have access to our unbelievable team of experts, Sarah, Andy, and Ian, who you've heard from, and myself. That's a pretty good team. To find an advisor near you, visit irahelp.com or check the link below. If you found today helpful, like this video and subscribe for more expert retirement insights. And let us know in the comments, what's your biggest retirement tax question? We'll be answering some in future videos. Now, at the start of this program, I asked, do you want your plan or the government's? Now you have the knowledge to take control. You understand the biggest tax traps and the strategies to avoid them. But knowledge only works if you take action. Retirement tax planning isn't just about avoiding mistakes. It's about securing your future and keeping more of what's yours. So take the next step. Use what you've learned, make the right moves, and make sure your retirement savings work for you, not Uncle Sam. In other words, take control of your retirement savings.
Yeah.